Hello, ma'am. Hello, classmate. So, we're talking about chapter 5 application of microeconomics theory as a basis for understanding the key economic variables affecting the business. So, I'm talking about introduction to microeconomics. Microeconomics focus on the behavior and purchasing decision of individual and firms. In a market economy, goods and services are distributed through a system of prices. Goods and services are sold to those willing and able to pay the market price. The market price is determined based on demand and supply. So, rationing is allocation of a limited supply of a good or resources to user who would like to have more of it. Various criteria, including charging a price, can be utilized to allocate the limited supplies. When the price performs the rationing function, the goods and resources is allocated to those willing to give up the most other things in order to obtain ownership rights. Demand. Demand is a quantity of a good service that consumers are willing and able to purchase at a range of prices at a particular time. Therefore, market demand for a product is actually a schedule of the amount that would be purchased at various prices, with all other variables that affect demand being held constant. So this is the demand curve. So price is going upward and quantity is going downward. So demand curve shift. Demand curve shift when demand variables other than price change. For example, if the price is substitute product X increase in price, the demand of for product X would shift upward and to the right. So product X will increase upward to the right. So, factors affecting the demand for a product other than its price. Factors: consumers' income and wealth, price of other goods and services, price of complement products, consumer taste, group boycott. Effects: generally a direct relationship, inverse relationship, intermediate relationship, inverse relationship. So the elasticity of demand. Price elasticity demand is defined as the relationship between percent change in quality demanded and percent change in price. This indicates the degree consumer response to variation in price. So, elasticity demand is measured how sensitive the quantity demanded is to a change in price. So, elas- elastic if a small rise in price causes consumer to choose a much smaller amount of a product, and inelastic is substantial increase in price result only in a small reduction in quantity demanded. so percent for inelastic demand is so for inelastic demand is percent change in quantity over percent change in price. Then 10% decrease over 30% increase equals to less than 1. So the elastic demand is percent change in quantity over percent change in price. 40% decrease over 10% increase equals to greater than 1. Then the unit elastic demand. Change in quantity over percent change in price. 20% decrease, 20% increase equals to 1. So Kinds of elasticity and inelastic. Perfectly inelastic. Despite an increase in price, consumers still purchase the same amount. And relatively inelastic, a price increase in price result in a smaller percent reduction in sales. Unitary elasticity. The percent change in quantity demanded is equal to the percent change price, thus a curve of decreasing slope result. Re- Relatively elastic. A percent increase in price leads to larger a larger percent reduction in purchases. Perfectly elastic. Consumers will buy all the farmers who wants corn at the market price, but none will be sold above the market price. So, perfect and elastic. Perfect and elastic is 0 percent change in quantity over percent change in price equals to 0. Then perfectly elastic is infinite. Then relatively inelastic is less than 1. Unit elastic is 1. Relatively elastic is greater than 1. So, supply. Law of supply is a principle that states that there will be a direct relationship between the price of a good and the amount of it offered for sale. Other things constant, a higher price will increase the producer's incentive to supply the good. A curve shows the amount of a product that would be supplied at various prices. That's all. Thank you.
Good morning, ka-business. My name is Carmela Rita and I will tackle about supply curve shift, market equilibrium and pricing and profits. Supply curve shift. A supply curve shift occurs when supply variable other than price change. A change in supply leads to a shift in the supply curve, which causes an imbalance in the market that is corrected by changing prices and demand. An increase in the change in supply shift the supply curve to the right, while a decrease in the change in supply shift the supply curve to the left. Essentially, there is an increase or decrease in the quantity supply that is paired with a higher or lower supply price. There are factors affecting the supply of a product other than its price. The first factors is prices of other goods, and the effect is inverse relationship, which means that when one variable increases, the other variable decreases, and vice versa. So if other products can be produced with greater returns, producer will produce those goods. Second is number of producers, and the effect is direct relationship, which means that two variables do the same thing. If one increases, the other one increases too. If one decreases, the other one decreases too. Generally, an increase in the number of producers will cause an increase in the amount of goods supplied at a given price. Next is government price controls. Price controls will tend to limit the amount of goods supplied by holding the price artificially low. Next is price expectation. The effect is direct relationship. If it is expected that prices will be higher for the good in the future, production of the good will increase. Next is government subsidies, and its effect is direct relationship. Subsidies in the effect reduce the production cost of goods and therefore increase the goods supplied at a given price. The last is change in production cost or technological advances, and its effect is inverse relationship. As production costs go up, fewer products will be supplied at a given price. If costs go down, more products will be produced. Market equilibrium and pricing. A market is an abstract concept that encompasses the forces generated by the buying and selling decision of economic participants. A market is a place where two parties can gather to facilitate a exchange of goods and services. The parties involved are usually buyers and sellers. The market may be physical like a retail outlet where people meet face to face, or virtual like an online market where there is no direct physical contact between buyers and sellers. Equilibrium. Equilibrium is a state of balance between conflicting forces such as supply and demand. Equilibrium is the state in which market supply and demand balance each other, and as a result prices become stable. Generally, an oversupply of goods or services causes prices to go down, which result in higher demand, while an undersupply or shortage causes prices to go up, resulting in less demand. The balancing effect of supply and demand result in a state of equilibrium. There are two kinds of market equilibrium: short-run market equilibrium and long-run market equilibrium. The first is short-run market equilibrium. It is a time period of insufficient land to permit decision makers to adjust fully to a change in the market condition. For example, in the short run, producer will have time to increase the output by using more labor and raw materials, but they will not have time to expand the size of their plants or to install additional heavy equipment. And the second is long-run market equilibrium. Is a time period of sufficient land to enable decision makers to adjust fully to a market change. For example, in the long run, producer will have time to alter the utilization of all productive factors, including the heavy equipment and physical structure and their plants. So here are the some impact and equilibrium and of shift in the supply and demand schedule. First is market prices will bring the conflicting forces of supply and demand into balance. If the quantity supplied to the market by producer exceeds the quantity demanded by consumers, price will decline until the surplus is eliminated. On the other hand, if the quantity demanded by consumers exceed the quality supplied by producers, price will rise until the shortage is eliminated. The second is when market is in a long run equilibrium, supply and demand will be in balance and the producer's opportunity cost will equal the market price. If the opportunity of cost of supplying the good is less than the market price, profits will accrue. The profits will attract additional suppliers, cause lower prices, and push the market toward an equilibrium. On the other hand, if the opportunity cost of producing a good exceed the market price, supplier will experience losses. The losses will induce producer to leave the market, causing price to rise until equilibrium is restored. The next is changes in consumers' income. Prices of closely related goods, preferences, and expectation as the future prices will cause the entire demand curve shift. Next is changes in output prices. Technology and other factors that influence the producer's cost of production will cause the entire supply curve to shift. Next is the constraint of time temporarily limits the ability of consumers to adjust the changes in prices. With the passage of time, a price increase will usually elicit a large reduction in quantity demanded. Similarly, the market supply curve showed more responsiveness to a change in price in the long run than during the short-term time period. Next is when a price is fixed below the market equilibrium, buyers will want to purchase more than sellers are willing to supply. Those shortage will result. Non-price factors such as waiting lines, quality deterioration, and illegal transaction will play a more important role in the rationing process. And the last is when a price is fixed above the market equilibrium level, sellers will want to supply a larger amount than buyers are willing to purchase at the current price. Those surplus will result. Short-run total cost. In the short run, firms have both fixed and variable cost. Total fixed cost. It is refers to the total expenditure made by a firm or industry to purchase the fixed factors of production for the production of commodity. In short run, it remains constant whatever change in output. Variable cost or VC is changes according to the quantity of a good or service being produced. It includes inputs like labor and raw materials. Variable costs are also the sum of marginal cost over all of the units produced. Average fixed cost or AFC. Fixed cost per unit of output. As the total number of units of the good produced increases, the average fixed cost decreases because the same amount of fixed cost is being spread over a larger number of units of output. Average variable cost or AVC is a firm's variable cost like labor, electricity, or etc. divided by the quantity of output produced. Variable costs are those costs which vary with the output level. Marginal cost. Marginal cost or MC is the additional cost incurred in the production of one more unit of a good or service. It is derived from the variable cost of production, given that fixed costs do not change as output changes. Hence, no additional fixed cost is incurred in the producing another unit of a good or service once production has already started. Average total cost is the aggregate of all costs incurred to produce a batch divided by the number of units produced. The outcome includes a combination of all fixed cost and variable cost incurred to produce the units, and so is considered the most comprehensive costing compilation for a production run. Fixed cost or FC is an expense that does not change as production volume increases or decreases within a relevant range. In other words, fixed costs are locked in place as long as operations stay within a certain size. Fixed costs are less controllable than variable costs because they aren't based on volume or operations. Long run total cost. In the long run, all inputs are available because additional plant capacity can be built. In the long run, a firm increases all production factors by a given proportion. There are the following three possible outcomes. First, constant returns to scale. Output increases in the same proportion. Second, increasing returns to scale. Output increases by a greater proportion. Third is decreasing returns to scale, which means output increases by a smaller proportion. In many industries, especially those that are capital intensive, increasing returns to scale occur up to a point, generally as a result of the division of labor and specialization in production. However, beyond a certain size, management has problem controlling production and decreasing returns to scale arise. Next is profit. Profits is an income distributed to the owner in a profitable market production process. Profit is a measure of profitability, which is the owner's major interest in the income formation process of market production. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in the sustaining the activity in question. There are two types of profit. First is the normal profit. It is an economic term that describes when a company's total revenues are equal to its total cost in a perfectly competitive market. Normal profit is included in the cost of production because it is the minimum amount that justifies why the firm is still in business. It is just enough profit to keep the firm in business in the long run. The second is the economic profit. It is a theoretical measurement of opportunity cost in conjunction with actual revenues. Economic profit is the amount of profits in excess of normal profit. In a perfectly competitive market, economic profit cannot be experienced in the long run.
Good morning, business. Good morning to you, ma'am. This is the continuation of Group 5, Chapter 5. I will tackle about production, money and interest rates, and the supply and demand for money. When we say production, it is the method of turning raw materials or input into finished goods or product in a manufacturing process. For instance, some businesses called as a set of product being produced at the same time of production run. Management makes production decisions based on the relationship between marginal revenue and marginal cost. Marginal revenue is the additional revenue received from the sale of one additional unit of product, and the marginal cost or MC of producing the good is less than or equal to the marginal revenue or MR from the sale of that good. When the price of input resource is determined by demand and supply, this could be the labor, raw materials, and support. If the price of an input increase, kung masaka ang price sa input, the demand will decline. Kung ang demand po mo increase, if the price will decline. In making decisions about employments of resources, management considers the marginal product for its input resource. The marginal product, it is the additional output obtained from employing one additional unit of a resource. The change in total revenue from employing one additional unit of a resource is referred to as the marginal revenue product. Next is money and interest rates, the role of money in the economy. Money is the any item or commodity that is generally accepted as a means of payment for goods and services or for repayment of debt, and that serves as an asset to each holder. On the simplest level, money is composed of the bills and coins which have been printed or minted by the national government. These are called currency. But Money also includes the funds stored as electronic entries in one checking accounts and saving accounts. Because money in a modern economy is not directly banked by intrinsic value. When we say intrinsic value, tinuod nga weight sa gold and silver, the financial system works on an entirely fiduciary basis, relying on the public's confidence in the established forms of monetary exchange. And money also serves as three main purposes. First is medium of exchange. It is acceptable in exchange for goods and services. This critical function avoids the inefficiencies of barter exchange. A market economy would be impossible without money. Second is the store of value. It is durable for exchange at a later date. This requires a stable value so that purchasing power is retained over time. And lastly, standard value or unit of account. It is usable for quoting prices. That's is the three main purposes of money. Next is the supply and demand for money. Money facilitates the flow of resources in the circular model of macroeconomy. Macro is not enough money will slow down the economy, and too much money can cause inflation because the higher price levels. Other way, monitoring the supply and demand for money is vital for the economy. Central bank's monetary policy, which aims to stabilize the price levels and to support economic growth. Kinahanglan monitoron ang supply and demand sa money kay kinahanglan level ra ang duha. The money supply. Although the general description of money is relatively straightforward, the precise description of the overall supply of money is complex because of the wide variety of forms of money in the modern economies. And next is the key measures for the money supply are. First is money one, the nervous measure of the money supply. It includes currency in circulation held by the non-bank public, demand deposits and other checkable deposits, and travelers' checks. And money one refers to us as primarily to money used as a medium of exchange. Second is money two in addition to money one. This measure includes money held in savings, deposit, money market deposit accounts, non-institutional money market manual funds, and other short-term money market assets. And money two refers to us primarily to money used as a store of value. Next is money 3. In addition to money 2, the measure includes the financial institution in large denomination, time deposit, and the term euro dollars. The money 3 refers the primarily to money used as a unit of account. And lastly, in addition to money 3, this measure includes liquid and near liquid assets in a short term, treasury notes and high grade commercial paper and bank acceptance notes. And the Bangko Sentral ng Pilipinas or BSP is responsible for determining the supply of money. It uses daily open market operations influence the creation of money by banks and to guide the availability of money in the economy. The BSP also has impact on the creation of money by bank through reserve requirements and discount rate, that is the interest rate and which banks can borrow from the BSP as a lender of the last resort. Changes in supply of money will affect the interest rate and therefore the cost of borrowing money will have an impact on consumption and investment levels in the economy. Next is the demand for money. The source of the demand for money are first is transaction demand. The money demanded for day-to-day payments through balances held by the households and firms instead of stocks, bonds, and other assets. These kinds of demand varies with GDP and it does not depend on the rate of interest. Second is precautionary demand. Money demanded as the result of unanticipated payments. This kind of demand varies on with GDP. And this precautionary demand, mo na siya maingat nga pagdesisyon. And last is speculative demand. Money demanded because of expectations about interest rates in the future. This means that people will decide to expand their money balances and hold off on bond purchases if they expect interest rates to rise. Kung nag-expect sila nga mo saka ang imong interest rates. This kind of demand has a negative relationship with the interest rate. Mo ni siya maisipon or madahon. The rate of interest is the price paid in the money market for the use of money or loans. The rate is a percentage of the amount borrowed. Next is the impact of money. The BSP's or Bangko Sentral ng Pilipinas monetary policy has an immediate short-run impact on the economy. In particular, is the higher interest rates will decrease investment because it becomes more expensive to borrow money and it will also decrease the consumption because customers will tend to save more as interest rate returns increase. In addition, as the higher Philippine interest rates increase the demand for peso on the foreign exchange markets because of the higher returns on Philippines deposits, the higher peso will decrease export by making them increasingly expensive. The monetary policy can be applied in the short run when the economy faces an inflation gap. Kung tanaw sila sa inflation gap, real GDPs exceeds potential GDPs. The BSP may then pursue a policy to avoid inflation by decreasing the quality of money and raising the interest rate. The higher interest rate decrease investment, consumption, and the net export. This decrease in aggregate demand will decrease real GDP and the lower price level. And next is the quantity theory of money. The quantity theory of money holds the changes in the money supply or MS directly influence the economy's price level but nothing else. This theory follows from the equation of exchange. Sunod siya sa equation. M stands for quantity of money times velocity of money. The average number of times a unit of money is used during a year to purchase GDPs in goods and services equals price level times real GDP. The equation of exchange essentially states that the economy's nominal GDP or expenditures P times Y equal to the money actually used in the economy or M times B. According to the quantity theory of money, velocity or V is not affected by quantity of money or M and is considered constant. V equals B. Also, potential real GDP is not affected by M and it's considered constant by Y equals Y. It not follows directly from equation of exchange m times b equals p times y. The change in m is equal to changes in p in the long run. This view of equation of exchange expresses the new classical neutrality of money. That is, money affects on nominal values but not real values. In other words, the money supply leaves real output unaffected. Wa siya nag-affect. The equation of exchange does not hold on in the short run, as the economy does not immediately adjust because of price inflexibility, although the relationship between M, or quality of money, and P, price level, may not be casual as suggested by quantity money theorists. By it also appears that there is a correlation between M and P, na sila'y correlations sa quality of money and price level in the long term. Therefore, growth in M can be used as a statistical estimate for the rate of inflation. That is, the central bank can be effective in stabilizing prices. It is less clear what the central bank in fact on short-term real GDP and the real interest rate is. And that's all my report. The next reporter will Jeannie Matukan. Thank you.
Hello everyone, so this is the continuation of our report. Interest rates. The interest rates link the future to the present. It allows individuals to evaluate the present value of future income and cost. The interest rates allows the lender to calculate the future benefit of extending a loan or saving funds today. Because of this, the interest rate is often defined as the price of loanable funds. So the interest rate is the amount charged on top of the principal by a lender to a borrower for the use of assets. So kung magpautang ta or kita'y mangutang, syempre naagyunay tubo. An interest rate also applies to the amount earned at a bank or credit union from deposit. Na-secured pa imuhang kwarta sa bangko na apagyud kay magain nga interest or tubo. So interest rate. So dito mo malalaman kung magkano ang pwede mong kitain sa pira mo o magkano ang tubo ng utang mo. How interest rates are determined. The interest rate is determined by the interaction of the demand and supply of loanable funds. Increases in supply will decrease the interest rate and increase the total amount of borrowing and lending. Decrease in supply will increase the interest rate and decrease the total amount of borrowing and lending. Investors demand funds in order to finance capital assets that they believe will increase output and generate profit. The demand of investors for loanable funds stems from the productivity of capital because they expect that expanding future output will provide them more than enough resources to pay the amount borrowed and the interest. Okay, akong nasabtan ani kay ang investor kay murag nag-loan siya din iyang kwarta iyang gi-invest. So mas ningdako pa ang kwarta niya, more than enough resources to repay the amount borrowed and the interest on the loan. So, another, about aning lending. So, na-curious ko nga nung kintahay mag-loan ta og 500,000 payable for 5 years. So, kintahay, di ba, ag kwarta nato karon ag peso nato karon kay magkagamay ang value. So dili sila logi di ay kay ung mubo ag peso magkataas po di ay ag interest rate. The rate of interest functions as the price in the money market. Money has a time value, and its use is bought and sold in the money market in return for the payment of interest. If the BSP were to decide to increase the quantity of money from MS to MS, the supply of the money curve would shift to the right, resulting in a decreased equilibrium interest rate. You may notice that interest on loan or savings can change from time to time. So today, the level of interest rate is determined by the interaction of the supply and demand for funds in the money market. So, paano malalaman ng bangko kung kailan ibababa o itataas ang interest rate? So, kailan nga ba? So, ito ay sa pamamagitan ng benchmark rate ng Bangko Sentral. So, ano nga ba ang benchmark rate? Ang benchmark rate ay isa ito basihan ng mga bangko kung gaano kataas na interest ang pwedeng ipatong. At bakit naman tinataas o ibinababa ang benchmark rate? Well, ginagawa ng Bangko Sentral ang pagtaas ng benchmark rate para kontrolin ang inflation o ang pagbilis ng pagtaas ng presyo ng mga bilihin. To make our economy stable or inflation does not make go out of control. Two markets, investment funds. From the word investment, is the rate of interest balances the demand for funds required for investment and the supply of funds from savings, depending on their time preference and the rate of interest. So it is a way of investing money alongside other investors in order to benefit from the inherent advantages of working as a part of a group, such as reducing the risk of the investment by a significant percentage. Next is the liquid assets. Households and businesses may have reason to hold assets in liquid form because the borrowers require cash in the long term. Keynes introduced the influence of the liquidity preference on the interest rate. So liquid assets, it can quickly and easily converted into cash. For example, a money market fund would be considered a liquid investment or liquid asset because it makes money from interest, but it's still quickly accessible to cash out. The nominal or money rate versus the real rate of interest. We have emphasized that the interest rate is a premium paid by borrowers for earlier availability and a reward received by a lender for delaying consumption. Rising prices means that when the borrowers repays the principal in the future, it will not purchase as much as it would have when the funds were initially loaned. Lenders will recognize they are being repaid with pesos of less purchasing power. For example, if borrowers and lenders fully anticipate a 5% rate of inflation, they will just willing to agree on a 9% interest rate as they were earlier agree on a 4% interest rate when both anticipated price stability. In other words, the nominal interest rate is the rate you pay on a loan. The real interest is the nominal interest rate adjusted for inflation. A higher real interest rate reduces a borrowing firm's profit and hence its willingness to borrow. A nominal interest rate can fluctuate, while real interest rates always remain fixed. Interest rates and risk. Interest rate in the loanable funds market will differ mainly because of differences in the risk associated with the loans. It is riskier, for example, to loan money to an employed worker than to a well-established business with substantial assets. The risk also increases with the duration of the loan. So it's just like if the interest rates rise, for instance, the value of a bond or other fixed income investment will decline. Interest rate risk is defined as the risk of change in the value of an asset as a result of volatility in interest rate. There we have three components. First, pure interest component It is the real price one must pay for earlier availability. Second, inflationary premium component reflects the expectation that the loan will be repaid with pesos of less purchasing power as a result of inflation. Then last, risk premium component reflects the probability of default. The risk imposed on the lender by the possibility that the borrower may be unable to repay the loan. Effect change in interest rates. Control over short-term interest rates is one of the most tools of the BSP to achieve its main goals of controlling inflations, smoothing out the business cycle, and ensuring financial stability. Short-term rates are relevant for loans with a relatively short length for repayments. Long-term rates are relevant for loans such as long-term corporate borrowing and 10, 20, 30 years fixed rates mortgage. So, from the word effect change in interest rates, the higher interest rates mean higher borrowing cost. So, mas dako ag tubo. People will eventually start spending less. So, dili na sila gastador. The demand for goods and services will then drop. Magkaus-us ang presyo sa mga goods and services, which will cause inflation to fall. So, the lower the interest rate, the more people willing to borrow money to make big purchases as house or car. So, ug gamay ang interest rate, mas daghan ang willing nga mangutang. Interest rates are one of the most important aspect of economic system. Why? It's because they influence the cost of borrowing, the return on saving, and are an important component of the total return of many investment. Moreover, certain interest rates provide insight into future economic and financial market activity. So, ang interest rate maoy ga balance sa atong economy. That's all. Maura to guys. Thank you. Salamat.